Beauty. Thank you. Okay, cool. Awesome. Super excited to have everyone here and really grateful for Alex and Jay and Neil taking time out of their day to be a part of this. I think that, what's been interesting about the Sask Startup Summit this year is that it's also, while the downside is we don't have, the in-person collisions that we'd like to have, we do have the ability to bring in kind of world-class people in different areas. And for this investor panel, I certainly think that we have that here with Alex, Neil, and Jay. So guys, thank you for taking the time here. I think the objective of the session is to get your perspectives on both companies you've invested in, your experience there, and then we'll kind of switch a bit into the new world of raising capital in the COVID world. But appreciate you guys being here, and we'll just jump right into it if that's okay with you guys. Right on. So my first question here is to Neil. And Neil, I've been very fortunate where I've known Neil now because we've invested in Salon Scale and Safety Tech, and then both sit on the board as investors with Coconut Software. And every time I'm able to interact with them, I've really learned a ton. So thrilled to have you here. And one of the coolest stories, I think, in terms of where you really got your footing underneath you as an investor goes with Howard Schultz and his little coffee company that's known as Starbucks. So can you talk about that first victory as an investor? What caught your eye, and how did that all come together?
Thanks, Sean. San Francisco is not San Francisco as of late. We've had a lot of fires and really, really, really bad weather here. The air quality is like below any imagination. You can hardly see the sky and can't see it. Day feels like night. We got night 24 hours a day. We're like in the North Pole. It's unbelievable. Plus you can't breathe. So don't stay out of this place.
Right. So now it's great.
So Trudeau was right. Don't let any Americans in Canada. We'll just screw you up. So unfortunately for us. Well, this goes back a long time. I'm 100 years old, so you can imagine how far this investment of Starbucks was. But this is early days of my venture capital days. I was an associate at Bay, and they assigned me Seattle only because I was from there. Bay, of course, was in Silicon Valley and still is, but and they told me to go up there and look for deals, since you're a UW guy and you may know something about Seattle. But so I ran into Howard through an introduction, and Starbucks was struggling mightily. He was looking for a Series C, if you can believe, and he struggled like hell with A and B and hadn't raised much money, so he was looking for like $20 million in Series C, and he had 8 or 10 stores, and 4 of them were struggling mightily, and one was making it and 2 weren't, and all kinds of issues, and basically it was a terrible idea, a terrible investment, and nobody should even touch it. But he was an amazing guy, and that's what really started me off on thinking about how and knowing how important people are. And he was just passionate about his idea, about his product, about his people, and everything around him. He just came right at you like, wow, I don't know what this guy's going to do ultimately. This is a terrible idea. This is way back now. A lot of you might not even been born when this happened. There was nobody ever heard of espresso or especially coffee in a store, and not just a restaurant. He got the idea in Milan. He was selling Swedish housewares prior to joining Starbucks. He got this idea by going into the little espresso cafes in Milan and getting a quick shot and hitting the trail. So the first store, and it still exists in Seattle at Pike's Market, is a stand-up only. There's nothing for sale. There's no seats. It's kind of just like now, and where you can't, if you go into Starbucks now, there's no, you can't stay. You got to get in and out. So that was what it was, but the issue was the people. He says they're going to be called partners, not employees. We're going to give them benefits. They're going to be part-time. They're going to be in their late 20s, early 30s. It's going to be a vibrant, live place, and we're just going to serve coffee. This is way, way, way before the tables and all the stuff they sell and all the seasonal stuff and all that stuff. So anyway, I take this idea back to my partnership, knowing, well, let's see what happens. And it was a brutal session. There, I was one of 6 associates, and there were 5 GPs at Bay then, and I was the first one up for the Monday morning partner meeting, which was the way they did it. They had the associates give their pitches, what they did the week before, and their great idea that they want the partnership to consider. So I got up and gave my little pitch, and I was into this thing about 10 minutes, maybe 15 at the most. And the head of the firm said, Neil, this is ridiculous. This is terrible. First of all, this is the worst idea I've ever heard of. This for openers. Second, this is a technology firm. You're a tech guy, right? If you ever bring anything like this in here again and waste all of our time, I'll fire you on the spot. This is awful. So don't ever think about this again. This was terrible. So hit the trail. And of course, the other 5 associates were loving it because I get my ass out of the firm if I do something crazy again. But at the end of the day, Howard gave me this sense of, you've got to be passionate about your idea. Maybe not overwhelming, but you got to be really a believer, and you got to take it to the next level about who you're going to hire, what you're going to do in the product, and all that kind of strategy. And this is really early on. So I just started believing in my future investments, that it was really about the passion that really matters, and how the entrepreneur presents their product and has knowledge of what's going to happen, and just believes in knocking down walls. And so I've kind of used that as part of my philosophy going forward in all the investments, and so far so good.
Right on.
That's it.
So
That's it.
I wanted to kind of move it over to Alex here. From Alex, we worked together on 7 Shifts as investors, and your role as a board. I've certainly learned a ton by kind of how you work with Jordan and the rest of the board there. But being an investor and a board member in companies like Touch Bistro and 7 Shifts, what was it that you saw in those companies? Was there something about the restaurant industry that got you and the Relay team excited? And can you elaborate on any different angles you had to give to an investment into? So that's the first piece, is the space and those 2 companies. But then also, when looking at 7 Shifts, did you have to run your diligence process any differently, because they're at the time almost an entirely Saskatoon-based company, now split between Saskatoon and Toronto?
Well, I would say let's start with the restaurant thesis to begin with, and the hospitality thesis to begin with. I think when you look back at our investment in Touch Bistro, we looked closely at the space, and it was at the time that the iPad emerged and said, this is going to change the way businesses operate. There's no question about it. Who can we back in this space that understands the technology and frankly thinks that restaurants are going to, and we looked at, I want to say 7 or 8 different restaurant, what's considered today operating systems, instead of just point of sale, and settled very fruitful, very, I'd say in good stead. We settled on doing a seed deal with Touch Bistro, for the most part because we had backed Alex Barati before. So this was a second-time entrepreneur, well known to us. We had made money with him in the past. We understood, what motivated him, what kept him, ticking, and how his view of the world and the restaurant world would be affected by iPads. And that's why we did the deal. We met Jordan, as a matter of fact, actually through the whole thesis-based value chain, you can call it whatever you want, investing, where Jordan was partnering with Touch Bistro and just kept coming through and relentlessly meeting with us. I just loved it. And they were great meetings. And an hour would turn into 2 or 3 hours. And the questions were going both ways. And he was just always curious and diligent and really, very personable. I would say in terms of our diligence on the person, number one, we got to know him really well. And this might affect how our discussion later about how we're sourcing deals today and how we're looking at deals today. But having gotten to know Jordan very well over 9-12 months, watching the curve go upwards, watching him make good hires, seeing where he was spending his time and how diligent he was in terms of the conversations we had with him, the decision got easier and easier, number one. And number two, the diligence on him as a character, on his character and his individual, like we just didn't have to spend that amount of condensed time with him because we already had committed to it down the road. This is why, like for me, that was a lesson. So this is 4.5 years ago. For me, this was a lesson in getting to know the entrepreneur really well before placing a bet on them. And that it sometimes it's not as easy as saying like, we're going to get to know you 9 or 12 months beforehand and then do the deal. It just sometimes doesn't work out like that. In this case, it did. And I would say at the seed stage, which is where I spend a ton of time and do a lot of our deals, I would say the seed stage is like 90% people, 10% product or idea. And so, you know, what do we look for in a founder at that seed stage? Well, you know, first of all, we're either looking for somebody who has built a business before, period, like Alex Barati, or we're looking for somebody who has experienced the problem themselves, like Jordan. His dad owned a couple Quiznos. You know, he shows this picture of him with his like terrible underbite or overbite or whatever it was. And he could like, it's a great picture with the schedule in the background and the date stamped at the bottom. And he still uses it in any pitch deck that I love it, right? And he's got his finger pointing to the schedule and saying like, this is the problem that I had and this is the problem that I was trying to solve. And then you say, we need to diligence the individual's character. We need to diligence their perseverance. We need to diligence their determination and how likely they are to succeed. And so we made our calls. Like I said, we got to know them. So the difficulty, I mean, look, at the end of the day, this was more about how much time we were collectively as a firm willing to commit to working with Jordan to build the business because we thought he could do it, and was less really about the capital. You know, $500,000 or $600,000 on a $150 million fund is not a huge check for us. It's a good inroad. We had got good ownership, a board seat, and committed to spending. Said to Jordan, look, you know, if you're interested in taking the money, then you got to be committed to seeing us here once a month, which is what we were doing, flying in and out of Saskatoon once a month. And, you know, now we're talking about a business that has scaled tremendously in 2 cities. Jordan is an incredibly mature CEO, and I have learned personally a ton from him.
That's awesome. And having, you know, the way our ecosystem's grown over the last few years, a big part of that is having people like you flying out here, having Neil fly out here for the Coconut board meetings, having Jay come out for the last Sask Startup Summit. You know, that adds a lot of value back into our ecosystem because it gets you guys, you know, more familiar with a lot of the companies as well. It's been great.
Well, you see, Neil got Seattle and I got Saskatoon.
Yeah, that's right. Yeah. So Jay, I wanted to ask you guys for, again, poking at kind of an investment thesis where you guys are looking at right now. You've got one of the market leaders in the ed tech space, or is quickly becoming that way, or looking like it in Thinkific, and then have just made another investment recently into Shobi in that space. What is it about what you guys are seeing in ed tech? How much of that is fueled by COVID, and how much of that has, you know, been kind of a part of the overall thesis for a while?
Yeah, so Sean, I promise I'll answer the question, but Neil, I just have to comment that San Francisco might be a mess, but your background, it looks like a green screen. What a beautiful office and home setup. That's unreal. So kudos on that Starbucks investment. It looks like a good number of chips went to good work there. And Sean, glad you dressed up for the occasion. So the question about us with an ed tech thesis, you know, I think generally speaking, Rhino Ventures, we're a generalist fund that operates in the pre-Series A turf. So we'll do pre-seed through to kind of junior Series A deals. And most of the time, we don't have a bottoms up, ground up kind of thesis on a space. We are opportunistic by design. We come across trailblazing entrepreneurs that have a thesis and have a perspective and have an unfair advantage in a particular category. And that's usually where our first investment is rooted in. And to Alex's point, it's 90% about the people, 10% about kind of the market that they're tackling in the existing product they have at the early stage. So for Greg and Thinkific, it was incredibly simple. This was almost like a carbon copy of Toby's experience at Shopify. So Thinkific is a knowledge commerce platform. The quick and dirty way to understand it is the Shopify for online courses. Greg built an online course for the LSAT space called Alpha Score. He had to build all the infrastructure himself and said, hey, there's got to be a better way, and built a platform around that. This was back in 2015 that we made the initial investment, right when Shopify, I think they had just done their pre-IPO round with Omers. So it was an exciting time. We were looking at that as an analog business. And it was obviously, for us, it was kind of a no-brainer decision. This was a first-rate founder in a market that seemed incredibly attractive. Some of the fundamental differences between selling knowledge commerce and physical commerce goods is that the margin profile, there's almost zero marginal cost associated with selling a next online course. This is an 80 to 90% gross margin product for most course creators, which means the threshold of how much revenue you have to generate to be a successful course creator is much lower. You can build a super profitable business by generating several $100,000 in online course revenue. So we really liked all those characteristics of the bedrock of Thinkific. But more importantly, we continue to follow kind of our winning portfolio companies. So we've led 3 subsequent rounds into Thinkific. We've done some kind of creative things that, Sean, you're privy to, where we've done SPV structures, where we've now invested over $20 million into Thinkific. And that's when we put that amount of capital to work, we definitely build a more concrete kind of thesis on the space and where things are going. So to your point around, is this kind of COVID flash in the pan versus more of an enduring change? We definitely think that education is a broken industry, full stop, end of period. If you look at consumer price inflation, this isn't a crazy insight, but if you look at inflation across a bunch of different consumer goods over the last 20 years, you have everything the technology has touched is either flat or going down, because a core component of technology is that it's deflationary. If you think of the meat of any value proposition is faster, better, faster, cheaper, and cheaper being a core component of any tech value proposition. And the areas that have inflated away, healthcare and education, both K-12 as well as higher ed, technology has just not permeated those sectors in a way that we think it should have. So that's the root kind of cause of the investments that we're making into the edtech space. Is we think it's broken. We think it's overdue for technology disruption. We think that the cost structure of education is totally inflated beyond what is reasonable.
Awesome, right on. And so, Alex, one of the things that I really enjoy in terms of what I've learned from you is your ability to see these macro trends and kind of predict where things are going. A great example of that was recently through our discussion where you've started to notice across the portfolio that cost per marketing is starting to go up as the beast of the American election is already starting to impact just general spending and in a lot of social channels. But other trends that I wanted to kind of learn from you is what have you seen since everything's been turned upside down from COVID? What are the things that you've noticed? What are the big lessons that you think early stage founders, which most of the attendees are here today, that they should be focusing on when it comes to either raising capital or building traction?
Well, thank you for giving me credit for that observation, but I will promise you that it didn't come from up here. It came from here, and hearing it from somebody who is much smarter than I am from a marketing perspective, and then validating it across a couple of companies. But it actually is interesting, and it is true, which is that the cost of marketing on social channels has just gone up across our portfolio. So that is, and we attribute it to what's going on with the election and the inventory that's actually being bought up by the politicians in the U.S. right now. But we'll park that for a second. And I think, look, the secular trend, obviously, that's going on in the industry at the earliest stage is access to capital and size of checks that are being written and the number of companies that are getting funded now. So, if you look at the macro trend and you would say, okay, I don't think venture is really in trouble. We're at 90% capital deployment, what we were at last year. And it just continued through Q2 and into Q3, and we're expecting similar numbers in Q3, both in the US and Canada. But it's when you dig in and you look at where that capital is being directed to, it's a lot of companies inside of portfolios that are getting propped up, and big checks are getting written into these companies so that they can either A, sustain themselves, or B, because they're seeing things which, we're seeing in a few companies right now, mass adoption, because people are at home for whatever other dynamic that's happening in the market. And so these mega rounds of $100 million or more, both in Canada and the US, are representing 75% of the overall capital that's being, 60% of the capital that's being deployed. And the companies that are actually being affected most in terms of being able to raise capital are probably the ones that are sitting on the call now. And the capital raising environment for a seed company that is pre-commercial launch is really tough. Really, really, really tough right now. And I don't have an answer for when things are gonna turn around there. But I do think that if you consider that what Jay just said about the secular trends in technology and the adoption of technology and all of that being correct, and it requiring less money to get to a proof of concept than we had required before, and a lot of the tools that are out there to help you launch that. I think personally, I think that market's going to start to come back, January, February, March-ish, where there will be more capital available. But for the time being, the seed stage really, unfortunately, in the pre-seed stage is a bit starved right now. And when you can raise capital, you might not be able to raise as much as you actually think you need. So you're going to have to make do with what you have. It's not like it was a year ago where, seed stage companies forget about valuation for a minute. It affects everyone on this call more than it affects us realistically, but it's the access and the amount of capital to get you to the next stage and what the right metrics are going to be based on the capital that you raise, if that makes any sense. Absolutely.
And Neil, similar question as you kind of look out your window into what looks like, I'm sure, a dystopian future, and all the startups that you've talked to in San Fran. What is it that you're seeing in the U.S. or even in your the Canadian companies that areas where you've been impressed of how people have been able to leverage it in times of COVID, be successful, but also challenges?
Yeah, Sean, I think I'm a little bit more bullish on being able to do business in the early seed Series A on our famous Zoomer. First of all, I've written about 5 blogs on my website that kind of deal with where we are. Let's just say there's 16 things to do as your business navigates times of uncertainty as existing businesses. Tips for raising capital right now, which I'll go into a little bit. Resiliency in a time of in face of COVID-19, and board responsibilities during this time. So there's lots of those out there, and I'm going to send one out Monday talking about preparing an effective pitch deck, which is the key in COVID-19 and our Zoomers, in my view. So the answer is, can you raise capital now, Series Seeds or Series A? And the answer is yes, it can be done. It's just a time-consuming process. Zoom takes forever, and I think that we find that people really don't know how to use a Zoom effectively. Starting with simple things like their sloppy background, they're ill-dressed, all the standard stuff that you wouldn't see if they were in your office, and they just haven't learned yet. Yes, absolutely, it's a relationship business, and I've been known to take people on runs and movies and lectures and all kinds of crazy things when I get to know them as we bring through the relationship process. But there's a Zoom etiquette. You've got to know when to interrupt and how to do it effectively. You've got to look good and be prepared, overly prepared. So you can do that. In a deck, you just have to build a very, very effective deck that you can get done in quick time and hard-hitting, meaningful, passionate, driven, directed kind of to get people to listen. You got to be also sure that the firm really is investing, or they're just listening to you babble on and not being effective. And you might be talking to an associate. Well, that's not going to help you in a decision process. So you have to it takes lots of Zoom calls to get to know the principals in the firm that'll be interested in your opportunity, is really the bottom line. We are about ready, and this has been 6 months, March 20th here, and now we're at close to September 20, to do a couple of them. One an early A, past the seed that we knew before, and one that we met like in April or May. And it was a long relationship, lots of calls, lots of due dilly. Somebody knew somebody who wasn't here. I mean, both of these were not here in San Francisco. In San Francisco, we could probably see people socially distanced. So I think that we have to be, you have to be absolutely convinced that Zoom's going to last forever. And you got to get on that and be effective and learn something from others. Read some of these blogs if you want to, or blogs like that, and just get after it. Sooner or later, your idea will work if you turn over enough rocks. It really will. And I have my blog says, okay, if you got an idea you like, then send it to me. Let's talk. I probably do 10 a week. 9.5 of them are bad, but sometimes you get a good one. And if a good one will resonate with the right kind of investor. Or you'll just tell them to try another firm. We're probably not the ones for you. But so
awesome.
It's doable. It's absolutely doable.
Right on.
Not easy.
Right. And Jay, anything to add there? And I gotta take off my sweet Tave hoodie after I take too many more pot shots about how slovenly I'm dressed today. Trying to support a portfolio company, and here I am getting attacked.
But it's called Dollar Shave Club, Sean. But yeah, so
look at Jay, nice button-down shirt.
Although I think the sloppy background might have been addressed at me.
That's it. Already,
yeah. So what do I have to add here? I mean, I take a little bit of a contrarian position here, just because at Rhino, we've deployed over 35% of the funds in the last 2 quarters, much to our LP's frustration. So we've been aggressively investing into this period of time, mostly, to be totally candid though, most of the entrepreneurs and founders are people that we knew before, have been building relationships with, and didn't have to do it entirely from a digitally native perspective, all on Zoom. So that's kind of the caveat towards the fact that we've deployed so much capital during this period of time. But something else that really stands out to me is what Alex brought up, is that 75% of the capital is going towards these mega rounds and these large growth equity deals that are happening. And there has never been, in my opinion, a bigger arbitrage between the prices paid for an early stage seed deal and what someone is willing to pay for a more mature Series B or Series C business. It is insane. We are getting bombarded every single day by growth equity investors for access to our top companies. And they are offering just ludicrous things that I've never seen to us as the GPs, which has crazy ethical implications that we obviously don't go down the path of. But it's, I've never seen the market this imbalanced before, where there is a lack of capital seeking that very early stage and high risk opportunity. And there's an overabundance of capital waiting for that at scale opportunity of, are you more than $5 to $10 million of ARR, or marketplace revenues is a different kind of threshold, but I've never seen this kind of crazy of an imbalance. So I view it as almost the best time in my 5-year investing, which is very short, but 5-year investing career. This has been the most opportune time to be deploying capital at the very early stage, because I think that inflection point in the value creation that takes place between when we invest and that next round is at its widest chasm. So that's all I have to add.
I agree, Jay. No better time. Absolutely no better time.
So Neil, go ahead.
From a value perspective, I agree that there's no better time, and we too are deploying capital right now. We closed the deal a month ago in the U.S. It was the deal we were tracking for a long time. But the numbers don't lie. And, the 3 of us can sit here and say that we're investing, and we are. I mean, I think we collectively, you just have to look at our websites. We're collectively investing. The problem is there are a ton of lower market funds. By lower market, I mean smaller sized funds that aren't doing what they did before. And you look at deals under $5 million over the last 6 months, and they're a third of what they were last year. So and secondary markets, unfortunately, Sean, secondary markets are the ones suffering the most right now, because they don't necessarily have the same. There is a benefit, though, by the way, which is that they have the cost to operate there is just so much less than it is anywhere else. And so the results are usually phenomenal, because the baseline expense to get there is a fraction of what it would be if you were in New York or San Francisco or Boston, or even Toronto.
Yeah, it is unfortunate where the secondary markets are being hit harder than established mature markets, because we just have such an overabundance. All of our companies are mostly at that seed stage, and we're in a point where, if you look at last year, the CVCA published their 2019 results. We had $114 million deployed in venture capital here in Saskatchewan. And through the first 2 quarters of this year, we've had $8 million into one deal, which Alex and I are familiar with. So certainly there's some challenges here. But Neil, for you as kind of one of the earlier outside investors into Saskatchewan, I know it wasn't that you came seeking deals in Saskatchewan. I think Catherine, you'd be the first to say that she's just such a sensational entrepreneur that she kind of dragged you into the ecosystem. But from the investment into Coconut and then Salon Scale and Safety Tech, what are the things that you've noticed here in terms of both strengths and weaknesses for us?
Well, I mean, Saskatchewan, I'm from Seattle, and I barely heard of Saskatchewan all my life, other than it's above Montana somewhere, and I was born in Montana. But, I certainly was familiar with BC and Toronto. But in any case, it wasn't quite that simple. I had a program called Neil's Running Start, where I invited 5 entrepreneurs that I had met, all of them in Europe. Helsinki, Berlin, London, Barcelona, and Dublin. And one of the Dublin person happened to be Catherine Renier, founder of Coconut. So I brought them all to California to teach them how the big boys and girls raise money, develop presentations, take their company to another level. They'd already been started. They'd been funded barely, but they did have a little bit of revenue, and they had a good idea what they wanted to do. But so I had about 7 or 8 of my pals in different firms, and I rented a house for them and nearby where we live, and put them up there for 6 weeks and ran them through the ringer in the Bay Area, venture firms, strategic partnerships, every incubator, all kinds of meetings, and basically a 24/7 schedule. And at the end, they all went away and raised money either there quickly or subsequently to that. And we didn't expect to have a winner of this contest, but Catherine was so exceptional to the rest that the 7 of us seeded her for, I think it was close to $1 million, 900 and something. And we said, okay, all you have to do to get this money is go close this $1 million financial or big $1 million order for the company in New Jersey that were ready to go. And she said, but I'm going to close that. And I said, okay, you go close it and you get the money. And sure as hell, it wasn't a week or 2 later, she closed it, and we sent her the money and got her rolling in Saskatchewan. And that's before we showed up there. We just gave her the money and said, hey, we'll be in touch. And to her credit, she lined up all of us that were investors to come to Saskatchewan and meet the team, such as it was, and to get to know some of the people in town. And she put together a one evening, like about 4 to 7 or 8 party or an event where we would speak, and the mayor was there, and government officials and people that were source of funding that are foreign to us, and a whole lot of entrepreneurs. And in my remarks to the group, I said, listen, this is a great opportunity here, and you all need to bring out your wallets and start investing in these companies and the infrastructure in Saskatchewan. Well, to me, it was the Saskatoon. I learned later it's part of a province and all the other Canadian things I didn't know very well. But bottom line was there was lots of great technology. They got a nice university there, and it just kind of took off, and not because of us, but because it was obvious they had to start doing something. And then Jordan started his incubator, or had been started before that, and it kind of built on itself, and they got other interested people coming, and Sean started his fund, and it's kind of built on itself. And I think now you have this little bit of a slide because of COVID-19, but still it's all there. The opportunity is there, and I've told a lot of people about it. So I think it's an up and coming place to spend time and energy and help some of these companies that are on the call today get started.
Awesome.
You have tough competition, but that's okay.
Yeah.
Do your goal. So,
and Alex, I know you got touched on some of our strengths as well, but Alex, are there any other kind of unique characteristics that you see from Saskatoon or Saskatchewan as a whole?
So I would say first and foremost, the part that I get most excited about, because I look at Toronto as an ecosystem in 2008 and 2009, and the first founders and funders dinner that I went to had I want to say 50 people. maybe, okay, maybe it was 450 and 40 showed up. And part of what the success of the ecosystem here is the growth of people individually in venture-backed companies and them spinning out and going to do other things. So if you look at the groundwork that Catherine's laid, you look at the groundwork from Coconut, you look at the groundwork from Seven Shifts or Vendasta or other companies in a small market with a small number of people, but the experience that they're getting and what they're learning, where they can go and eventually spin out into building their own business and becoming their own entrepreneurs and taking advantage of the resources, because the community is so tight there, but of the resources that they have. I think that there's a huge opportunity that's going to come from there. Just a huge, and the way that the integrity by which people operate there is just unbelievable. So, for me, it's actually it's a pleasure to go fly in there, spend a day, and then have a meeting with Jordan. Pleasure.
Right on. And Jay, any kind of further comments as well? I know you guys have made an investment into a secondary ecosystem recently in Edmonton. We've co-invested in Curatio, which has a presence here, obviously in Saskatchewan. But what have been your trends that you've noticed since starting to come out here more often and pay a bit more attention to the ecosystem?
So what I really like is how concentrated and cohesive the entire ecosystem seems to be around a few core hubs, like the work that Cultivator is doing and Conexus. It's concentrated in high hit rates of good opportunities, which is so important. I can speak to Vancouver. It's insanely fragmented. It's a total disaster in terms of where the concentration of the bodies that stand up and all entrepreneurs kind of stand behind. So that's a really good positive that's happening for the ecosystem. So kudos to all the work that Cultivator is doing. I think, when we look at ecosystems across Western Canada, which is the domain that we invest in, we map it across 4 categories that we call the 4 M's. Super basic, but it's money, mentorship, entrepreneurial management, and momentum. And those are kind of the categories that we look at to see what areas are picking up steam. Entrepreneurial management is arguably one of the most important sectors. I think this is going to change dramatically in this kind of remote first and distributed teams kind of format going forward. So I'm a big believer in the Saskatchewan overall kind of ecosystem. I think one of the other attributes of Western Canadian companies is that they build durably strong businesses very early on, not because that's their first choice, but out of absolute necessity from a lack of actual capital. So you'll see way more businesses that get to $1 or $2 million of annual recurring revenue that haven't raised a dime from angel investors or VC investors, as opposed to what we look at almost every day in Vancouver. That's stark contrast in terms of how durably sound those businesses are. And the weakness is take that really strong starting point and then extrapolate a much broader kind of venture scale vision. And that's the point that I think needs some more crafting and work.
Right. Yeah, no, it is. There's, again, a lot of really exciting momentum here, but certainly a long ways to go, which if anything gets us even more excited about where things could be in the future. So Jay, sticking with you, can you, the summit here is all about getting our province's best early stage founders together and colliding. And can you think of any founder that you guys invested in or that you've worked with in the past that you think is truly exceptional? What was it that made them really stand out to you?
So this is going to be really easy to rhyme off a few attributes, but it's much harder to actually see it kind of in motion and in real life. But when you see it, you recognize it and it's palpable. But so I'll take, for example, Jason Smith, the founder CEO of Clue, a business that just announced kind of a $15 million Series A yesterday that we participated in. We're investors in the seed round previously. And a few key attributes. One, he loves to win. He's got a winner's kind of attitude that he wants to build something massive. He undoubtedly attracts and retains the very best talent, which is tied to his ability to communicate incredibly clearly the vision for that business and set a venture scale opportunity and venture scale strategy such that it's very compelling for talent to come and work with him. He's humble, but incredibly capable and very confident. He's got that tenacity, which is a piece that you have to, I think, underline with first-time founders, that it takes a long time to build enterprise value in a technology or technology enabled business. You could be at this for 7, 10 plus years. So you have to make sure that this is a problem that you're willing to go the distance with and dedicate 7 to 10 years of your life to solving. So tenacity, that stick with itness, those are all kind of great attributes of founders, and part of that kind of the maxim that we would look for when we're looking to invest in people.
Right. And Alex, passing the question over to you, are there any kind of founders that you think have really set the bar that you've worked in the past, more that, key attributes or reasons why you think they truly were exceptional?
It's different for each individual. That's the thing. It's very hard for me to just say this is what makes this person exceptional. But I think it is true, and you read it everywhere. Exceptional people hire exceptional people. It's the most important characteristic that you need to look for. That they don't think that they can do everything on their own, and they understand their limitations. And building teams is really about that. How do I hire for my weaknesses, and how do I improve on my strengths? And every leader that we've invested in where we've been successful has been able to do that. But it's so soft, and it's such a soft feel, and it really is. I think it. By the way, it varies from individual to individual to individual, and it's also about the type of relationship. We have like long-term relationships with these individuals. We sit on boards with them, but we're also, we should also hopefully be their first call when something goes wrong, and their first call when something goes great. And that's the type of relationship that we try to build. So there needs to be openness and directness and respect for one another. And I always also think back to, my days playing rugby, which was you beat the crap out of somebody on the field, and then afterwards you go out and drink together and sing songs, right? Like it's a crazy, it's sort of crazy and irrational to think about it, but business is a little bit like that too. And so, you got to be prepared to have a life together outside of the boardroom.
Right. That's awesome. And so Neil, taking a bit of a different angle on this.
Hey, Sean.
Yeah.
Don't forget about luck. You got to get a little lucky too.
Yeah. I'm kidding. And so Neil, I'd like to hear your perspective, but in a bit of a different direction, where you've mentored dozens, probably hundreds of founders and venture capitalists. I count myself very lucky to be, among that group, and all the learnings that I've had from you over the years. But, starting first, what was a mentor that you had that really made a big impact? And then more importantly, in terms of, when you approach mentorship, what are the things that you recommend people look for in terms of finding a great mentor or fit? It's an area that you've been really strong in and continue to be active in.
Well, I mean, I've had, believe it or not, I had a real job at one time. So when I had a real job, you look for people in the business or in the company you're working for that you might learn a lot from. So you befriend them and get to know them, and both business wise as well as socially. And they're not waiting for you to ask them to be mentor, but I think you become friendly with them and they respect you for that. You get a shot at getting a mentor, and that's when I had a real job. Now, when I joined Bay as an associate, I had failed on 2 out of 3 startups, and the firm Bay had invested in all 3, and they said, "Well, Neil, we might want to have you come in here if you're interested and get some of the money back that you lost for it, the first 2." And I had like nothing else. I had nothing going. I hadn't think about the next idea, and the last thing I ever thought would be a venture capitalist. I wasn't sure what the hell they did. I came in once a month and shit on me and left, and not really helping me a bit. So anyway, I joined the firm along with 5 other associates, and I instantly knew the man that I should get to know and learn from was the managing general partner at the time, John Friedrich, who stayed with the firm until 2000, then he retired, but handed me the keys. But he was a very caring, smart lawyer that got tired of the legal game, and he wanted to get into venture capital. But he was the first one to tell you that he didn't know much about technology, but he knew a lot about people. He was the #1 in his law school at Stanford and on the board there, and really into the community. And he told me, "Neil, you're going to be successful with this business, I'm convinced, because I've got the money and you got to go make the calls." But he said, "You want to be able to give back to the community. You want to give back to people. You want to be more aware of your surroundings and just grinding every day in the business. And knocking pins down and making investments and being a nasty board member when you needed to be. So he taught me to be kind of a kinder, gentler person. When things got tough in any way part of life. And so I've followed him and his advice and counsel forever. Now that didn't happen right away. I was new to the firm, and even though he was on my board as a CEO, I didn't know him that well and never thought about him actually becoming a mentor. But as I saw the firm, saw the way it worked, and saw my associates and my fellow workers, I decided this was a good thing to do. And I did it pretty subtly. I didn't want everybody to know that I was, doing something that would be kind of looked at, oh, gee, just kissing the rear of the senior guy. And so I learned a lot from this guy. He was unbelievable, just a great guy and a great leader and a great person and a great community person. Everything about wonderful people. He was top of the list. So that's really what I did. And I just decided that was a good thing to do. Probably somebody probably told me about it actually. But so if you find somebody that you really like, whether they're in your business or not, just have lunch with them or have coffee with them or just chat with them about, hey, I think I can learn something. People are always flattered when somebody asks you to think about being a mentor.
That's awesome.
Most people will do it if you're asking.
So we have a question from the audience here from Dan Cugnan asking, how significant of a catalyst will COVID be in the coming years to accelerate and transform e-commerce, digital transactions, and online interactions of all kinds? So we've seen the big shock from COVID. How big of a impact do you think this is going to have long term? Jay, I'm going to pass it over to you to start, if that's okay.
Huge.
Yeah, sorry, just going off mute. Yeah, so I heard Neil mumbling huge. I totally agree. It's going to be gigantic. So I mean, McKinsey calls it the quickening, the great accelerant, and it's so the question I think specifically was around e-commerce. So I can give some hard stats on that. We have one of our largest portfolio companies, a business called Article.com, which is a direct consumer furniture and home accessories business. We have, traditionally this is a high growth business, but from a high absolute base. So in the hundreds of millions of dollars of revenue, we were planning to grow about 30% this year. COVID took that 30% to what we're now forecasting at about 75%. The gigantic question in most physical goods and e-commerce businesses' minds are, Alex touched on point number one, which is what's happening to the supply and demand dynamics of paid advertising, paid search and social, and what's happening from a customer acquisition standpoint, and how much of the future demand has been pulled forward as a result of stimulus spending. So because of things like CERB and government stimulus spending in the US, where they've been giving direct allocations of capital to individuals, how much of that traditionally strong Q4 spending, this is a near-term lens, how much of that traditionally strong Q4 spending has been pulled forward into the Q2 and Q3 spending cycles. So big unknown there, but undoubtedly take furniture. This category was historically about 10% penetrated online. No furniture and home accessories brick and mortar stores opened during the depths of the pandemic, which meant all consumption of furniture moved online, which meant that new consumers had their first time experience consuming that product online. And we think that that is a step function change in terms of take a 10% penetrated online category to 20% and then grow nicely thereafter. So this is a huge accelerant for all e-commerce out there.
Right on. Alex, do you have anything you want to add to that?
I mean, if we, a year ago, we would never have asked questions around how do you address this, a remote work environment? How do you address people that are going to be working from home for the next year and a half? How do you address people not wanting, we would never have asked those questions. Now, in any business that we look at, we will never ask questions about how are you going to bring people into a store? How are you going to make sure that you get through distribution through a retail channel? Like, I mean, it is completely changed the dynamics of any business, not only that we are looking at, but any business that we've invested in. It's crazy. Look at the restaurant business, by the way. Look at like the most significant increases that we've had in upsell have come from changes to the platform to help delivery faster, to help understand if people are coming to work sick or if they've or not. Like this is the whole dynamic of how We've changed platforms. We've changed product to focus on the current environment that will be our new normal. It is the future.
Yeah. And Neil, you've been through the bubble bursting, you've been through the '09 crisis, and now COVID. What are you expecting from the lasting impacts that we're going to see from these new trends from COVID?
Well, it's gonna affect everything, really, Sean. Our business, but travel, leisure, flying, meetings, events. So I mean, it's a no-brainer. You got to get with it. If you don't, you're gonna die.
And, okay, so one other kind of key question here, again, a big portion of the 45 or 50 attendees on this call are early stage founders who are going to be trying to access capital sometime in the next 12 or 18 months. What's the one thing they should take away right now as they look to raise capital in 2021 or even later this year for how they can go ahead and raise capital? Jay, I'll start with you.
Thanks, Sean. First kick at this one. All right. So listening to the pitches this morning, I think most entrepreneurs did an exceptional job communicating the story, doing what I tell most entrepreneurs, which is, show, don't tell. Show us what you're doing in terms of attraction. Show us in terms of what the go-to-market strategy actually looks like. I think that the presentations on the whole were exceptional. But for anyone that wasn't pitching this morning that's on this call now, the principle of show, don't tell. So show me the traction, show me the actual plan that you're going to be executing on, show me the V1 of your hypothesis and thesis on the market is an important takeaway. And then one other major point is I see a lot of very early stage entrepreneurs spin their tires trying to raise a couple $100,000 for 6+ months, and that time wasted could have been spent going out and acquiring your first customer, stitching together a really ugly MVP and doing something in a very hacky way. And that is going to do wonders in terms of unlocking the capital that's available for your business if you're able to just get out of your, I guess you have to do it on Zoom. I would have said get outside and go and close a customer, but get on the Zoom calls and master the Neil etiquette of Zoom and close some customers, build a hacky product, and then go out and raise your initial pre-seed capital.
Right on. Alex, what's the one key takeaway that our young founders should have here?
I'm going to drop the mic. I can't say it any better than Jay. That was great. Really, it was perfect.
Neil, do you have anything to add there? Oh, you're on mute, Neil.
According to TechCrunch, investors look at the pitch deck for 3 minutes and 44 seconds. That's how much time you have to win. So I think given that pitch deck better be short and sweet, but you got to make us believe. Make us believe they want to take the next meeting. Get to know us. And we'll get to know you. But as Jay said, the longer you wait to raise money, the more you prove, the better we'll like you. So talk to us about that. Come back to us in a month, say, I got 2 customers now. Here's what they're doing. Let's have another meeting.
That's awesome. Well, guys, I can't thank you enough for doing this and coming on these. I know these are tough to run these panels, in a virtual environment, but the number one goal here is to get some, actionable content out to our attendees. And I feel like there's a ton of learnings that they would all grab here. So I really appreciate you guys taking the time here. Our ecosystem, as young as it is really moving in the right direction. And it's because of these early stage founders who are putting together some exceptional companies, and because of the attention that you guys are giving to us. So really appreciate the 3 of you guys being here today. Thank you.